From New York City, for our viewers worldwide, I'm Matt Miller. The countdown to the Open starts right now. Coming up on this Tuesday, U.S. PPI hotter than expected, so the inflation picture still looking a little bit hawkish, sending yields higher ahead of Chairman Powell, who will speak later, and raising concerns about upcoming rate cuts. Obviously, that's the issue for these markets. We begin with the big issue, more signs of stubborn inflation.
Disinflation has stalled. I think that's the trend that I continue to see. And when you look ahead, we've had a lot of tough talk out of the administration about tariffs. The little relief that we're getting on the inflation front is more coming from goods. And that looks unlikely. That sort of global trend of lower goods prices seems unlikely to stay with us as, sort of all of the low level news that leads us to create our top line CPI forecast is just continuing to push higher.
We still have a relatively mixed picture in terms of futures, so it doesn't look like the PPI report has pushed us down too hard. Joining us to talk about it is Nuveen's Saira Malik and James Camp of Eagle Asset Management. Saira, let me start with you. What do you think as far as the inflation picture? Again, as Lara Rain was just saying, disinflation has kind of gone away. Maybe inflation is back in the picture. Is the Fed going to raise rates and hurt the rally that we've seen in stocks?
Well, first, let's start with PPI. We need to look at two things here. How does it translate to PCE? And really, what is this? If we parse the data, what does it mean? So first, on month over month PPI, it looks hot, but much of that is because March was revised down. Year over year is more in line. So I don't think PPI is as concerning as it looks on the surface. And then second of all is how does it translate into the Fed's preferred barometer of inflation, which is PCE? Most of the metrics were actually pretty tame, except for portfolio management, up almost 4%. So I'm less concerned about the PPI translation to PCE, but I am still concerned about CPI, which may make baby steps towards moderating tomorrow, but I don't think CPI is going to be enough to change the Fed's path to less rate cuts this year rather than more.
James, what do you think?
I think the inflation data has been menacing for the Fed. I think they've got a lot of things wrong, and I think the main takeaway that I have is it's a different economy than it was pre-pandemic. Labor market is different, supply chains are different, and producers now have pricing power they've never had, at least after the financial crisis up until the pandemic. So I just think there's a lot more inertia to inflation that is being given credit for. I think a lot of the data series are going to have some easy base effects, so the headline data will come in higher. And I think the Fed is going to be really, really tough to justify moving policy lower from a rate standpoint because they haven't hit that mandate yet on the 2%.
By the way, James, what would you buy if you were worried about inflation? I mean, what's the number one asset you think is the best place to hide in if you're worried about inflation? Is it still gold? Is it Mag 7 stocks? Is it a Bitcoin?
Well, I'm going to defer on the crypto, but I would say that companies with great balance sheets, pricing power, and that can raise income in the form of dividends, that's the best inflation hedge historically. If you want to protect your purchasing power for the goods that you consume every day, own some of the great companies that produce those because they still have pricing power and dividend acceleration and dividend performance. I think is going to really have a great year in 2024.
Saira, what do you think? If you were worried about inflation, and obviously tomorrow when we get the CPI print, we'll have a better look at where inflation is going. It certainly seems like it's still going to be up above 3% on the headline and even higher in the core. If you were worried about inflation, where would you hide?
Well, I agree with James. Looking at quality companies is important. I am worried about inflation. I think it's sticky and it's going to be here for longer than investors hope. So two categories. Dividend growers, like James mentioned, and also infrastructure companies. So starting with dividend growers, these are these high quality companies with strong balance sheets. They tend to raise their dividends over time so that these companies have strong fundamentals. If you look at market returns, in down markets, they tend to outperform historically. And in up markets, you capture most of that upside. So they're a nice defensive play for equities. Infrastructure companies tend to be inflation hedges because of the kind of contracts that they have. Now, also, they have a lot of tailwinds with where the U.S. is going. Number one, bringing more of our manufacturing back home needs more infrastructure. Second is also, as we move to more renewable energy, we need to update our grids. That again is more infrastructure. It's less economically cyclical because the components are mainly utilities and waste management. We still turn on and off our lights and take out our garbage during a recession. Those are two categories I think that you can use to balance the other side, which is the mega cap 7, which should continue to do well even in a slower economy. But given their premium valuations, I think you need to look at lagging sectors like dividend growers.
Are we looking at a slower economy? I know that GDP print last time was below 2%, but people are raising their expectations for GDP this year. I think the average right now for 2024 is like 2.5.
But I think looking at three things, GDP, manufacturing, and employment markets tell you the economy is moderately slowing. So first, GDP, as you mentioned, first quarter GDP missed consensus expectations. Manufacturing data, some of the manufacturing data we've seen recently says that the economy is in contractionary territory. Employment's very important here because that has been one of the key drivers to this economy. Just last month's payrolls came in under expectations, and claims last week actually bumped up. We've been in this range of about 210,000 to 212,000 for claims for about the last 2 months straight. Last week, that number jumped up again. So it's one data point, but it is telling you maybe we are finally seeing some incremental slowdown in the employment markets.
James, you also think we're seeing a slowdown in this economy, or we will see a slowdown in the economy?
Yeah, Mangus, and I think it's here for the down market consumer. If you look at the bottom, 80% of Americans, their budgets are stretched. Credit card debt's accelerated. This regressive nature of inflation is caught up. Down market retailers are struggling. I think you're going to have a material slowdown Q3, Q4. These Fed policies will have a bite. They're biting small business. They're biting, as I mentioned, the down market consumer. Where they're accretive is the large companies with massive free cash flow that can sweep their money into 5.5% money funds. And the other part of the story, I think, is this government impulse, this fiscal impulse that we've been kind of living with over the last couple of quarters has accelerated GDP higher than it otherwise would have been. And what's problematic about policy is we're deficit spending massively into an expansion. And I think all of that is gonna come to a pretty harder landing in the back half of the year than I think most are expecting.
All right, so income investing here firmly back for both of you. I want to take a moment to focus in on that PPI report right now, coming in hot with plenty more data to come this week on the inflation front. Bloomberg's Michael McKee joins us now for more. Mike?
Well, Matt, let's take a look at the headline numbers that did upset the markets. However, briefly, as we saw the PPI headline and the core X trade come in hotter than expected, much hotter than expected, although on a month-over-month basis, the PPI headline didn't move a whole lot. But you look at those revisions to March, and it leaves us with a little bit less of an index change than we would have had, but we also do see stronger producer price gains than we thought we would have. I threw in NFIB small business. You were just talking about whether the economy is slowing, and while the small business people think that the outlook isn't great right now, they're feeling more confident than they were last month. All right, let's take a look at the CPI, PPI, and PCE and what they've been doing. You can see the white line. That's PPI, and it has been rising much faster than the CPI and the PCE, at least if you look at it on a normalized basis, and that was particularly true this month. But as you can see, CPI, the yellow, not rising as fast, still rising. What's going to happen to it? And what's going to happen to PCE, which is the number that the Fed is watching? Well, there are a couple of things that go into the PCE from the PPI and CPI. Among them, home health care and hospice, which was up only 0.1% after a 0%. Healthcare is a major part of the CPI. Portfolio management, this is the POGO index. These are the people who get paid more when the markets go up, and you can see what happened. And I'm looking at you, equity guys, because the yellow line is equity, and that's you're the ones who are making the money right now. Bond managers not doing quite as well, but that's part of the problem. That'll go into CPI and PCE. One thing I left out, though, Matt, is airline fares down 2.3% on an unadjusted basis. Seasonally adjusting that for the CPI and the PCE could mean an actual lower than expected number for those indicators for the month of April. So we're going to have to watch that.
All right, Mike, thanks very much. Michael McKee there, Chief Economics Correspondent, looking at the actual PPI report that we got it at 8:30. We're going to get the CPI, obviously, tomorrow. I'm talking with Saira Malik at Nuveen, as well as James Camp at Eagle Asset Management. One of the things people are starting to talk about again is stagflation. And as you're both worried about a slowdown in the economy, and Saira, you point out you're worried about inflation as well, where does that leave the Fed? What do they do if we do have slowing growth and an inflation nut that they just can't crack?
Well, that's going to be a challenge for the Fed. And, when CPI comes out tomorrow, I think if the number is above 0.4%, that will increase that stagflation narrative. That's going to be where inflation is just continuously staying sticky and hotter than expected. And now we're seeing the other side of that with slowing manufacturing data and some uptick in unemployment, which could be concerning. I think stagflation would be an issue, look more like the 70s. That'll delay Fed rate cuts. We were always in the camp of 3 or less rate cuts for 2024. I'll take the under on that. I think we're probably going to get 1 to 2. Let's also not forget that during an election year, the Fed tends to do less, not more. So as we get closer to that November election, I think the Fed will likely just hold back and do nothing because they don't want to look like they're influencing the election. So that gets you to maybe 1 rate cut later this summer. And if not, we're probably waiting till December. And they're not going to cut rates until they see some signs of inflation consistently moderating. And we're not seeing that yet.
James, what's your Fed expectation? I mean, I know it's kind of a parlor game, right? And it's a moving target. But as Saira points out, in an election year, their hands are going to be tied for at least a few months.
Yeah, I think the calendar is not in their favor. We've sort of been of the belief that the Fed doesn't need to cut, shouldn't cut, if they're true about the mandate of inflation. The likelihood, though, Magnus, in this environment is that we're not going to get to 2%. The period that was the decade prior to the pandemic, I think is going to be the historical anomaly with goods deflation, with companies chasing low costs around the globe. That model's changed. And I think we just have to realize as investors and as a population that the economic model is different, the labor market is different, supply chain is different, and that a normal rate of inflation may not be 2%. I think the Fed's going to ultimately have to pivot to that narrative. I think the big problem with policy is it is continuing to bifurcate the economy. Maybe a more subtle point, but it is accretive, as I mentioned, to companies with massive cash flow. It's accretive to high earners and wealthier people that can invest in short-term instruments at 5.5%. And it's really adding to the inflation burden, down market consumer and small business. I think that's where policy gets really tricky.
I got to ask you about the market specifically, James, as we get closer to the open. And, I know this sort of frothy stock, meme stock picture may not be your bag, but you deferred on Bitcoin. And I'm looking at GameStop right now, indicated to open at $66, so doubling and then some. Again, from yesterday, 2 weeks ago, we were at 10. What do you make of the high price of these kind of assets, Bitcoin, GameStop, AMC? What does that mean to you if investors are driving these up?
It tells me there's more liquidity in the system than people realize. You see that in a lot of different markets. We see oversubscribed corporate bond markets, oversubscribed treasury auctions. These sort of phenomena with the meme stocks are perhaps interesting. I just defer back to the tried and true that we do. At a Fed peak, we know a couple things. 1, 3, and 5 year bond returns are excellent. 1, 3, and 5 year dividend growers are excellent. And for people that are investing for the long term, investing for retirement, the income landscape has not looked better to us in a decade or two. And I would stick with that, the fundamentals, individual companies, kind of knowing what you own. If you want to play in these other things, carve out a piece, let it be your play money. But the center of the plate investment universe looks really attractive to us right now.
I know, Saira, you like Fifth Third Bank in terms of stocks. Give us the elevator pitch as to why.
Sure. So bank stocks here also in an elevated interest rate environment where rates are peaking. Bank stocks are starting to look more attractive. You can see that with the technicals, where regional banks are starting to look more promising. Fifth Third in particular, very nice geographical exposure with its southeastern footprint. Also, net interest income is strong. Delinquencies have not been very elevated, and also cost cutting good for Fifth Third Bank. So we just love the geographic positioning, the growth prospects for them, and in an environment where we are finally moving past rate hikes and more towards rate cuts, this is good for generally the regional banks.
All right, Sarah, thanks so much for joining us. Saira Malik there, as well as James Camp from Nuveen and Eagle Asset Management, respectively. Great to spend some time with you on this Tuesday morning. Joining us now with a look at the other stocks that are moving ahead of the open. Here's Abigail Doolittle.
Matt, it would be hard to not take another look at those meme stocks. And of course, the rally set off yesterday by the potential return of Roaring Kitty. That is the name on X of Keith Gill, who set off the 2021 big rally for some of these meme stocks. And you can see, as you were mentioning, GameStop at $67, its highest level since 2021, up 121% after rallying 74% yesterday. AMC going along for the ride. As for some stocks that are not going higher, Home Depot right now down about 1% in the pre-market. This as sales have dropped for a sixth quarter in a row amid housing market woes and, of course, do-it-yourselfers not being quite as active. Coinbase down 2.5%, and this, of course, with Bitcoin down, but we also had an outage that ruffled some of those crypto markets. And then finally, Alibaba, after trading up more than 5% over the last 3 trading days, into today down 4.7% on a quarter that's being seen as somewhat disappointing given huge investment losses, Matt.
6 quarters in a row of declining revenue at Home Depot. I was there last night.
Was it busy?
Yeah, it was busy.
The one downstairs often is.
Not as busy as it was during the pandemic, and that's the issue. Abigail, thanks very much. Abigail Doolittle with a look at stocks. Just about 15 minutes until the opening bell. Coming up, the U.S. consumer under pressure.
The consumer, you know, when you look at credit metrics, you look at the savings rate, yeah, things are softening a bit, but they're still not terrible.
Higher interest rates are the problem. We dig into Home Depot's latest results, deeper into Home Depot's latest results next. This is Bloomberg.
Broadly speaking, the consumer has softened a little bit, which you know makes some sense given all the pressures that are out there. However, generally speaking, you're seeing total retail sales are still up a couple of percent. Some of that is inflation, I get that, but the consumer, you know, when you look at credit metrics, you look at the savings rate, yeah, things are softening a bit, but they're still not terrible.
The consumer is in focus again as retail earnings ramp up this week, really ending earnings season. Home Depot, one of the big ones, reporting a sales drop for a 6th straight quarter amid weaker demand. This comes ahead of Walmart earnings out on Thursday. Joining us now for more on the retail landscape is Bloomberg's John J. Edwards III. And John, I was just talking about this with Abby. I know, you know, I was at Home Depot yesterday. It was pretty busy, but not as busy as it would have been during the pandemic. And I guess that's the main issue, right?
Yeah, it's exactly that. They're still coming off of that strong performance they had during the pandemic when everyone was stuck at home, you know, improving their homes and, you know, buying lots of big ticket items. You know, they've now bought those big ticket items, and that plus inflation means that they are really not, you know, shopping for those high dollar items anymore at the moment. You know, so you know, some analysts are expecting to see Home Depot come back, you know, toward the end of the year. But it's still a rough period for them with that combination of, you know, consumers pulling back plus, you know, persistent inflation.
What needs to change here? I mean, is a rate cut really going to help if the Fed cuts 25 basis points or even, you know, 50 by the end of the year? Is that really going to help Home Depot?
That's a good question. I mean, you know, there's the extent to which it you know, maybe spurs, you know, some more home activity. But you know, I think a lot of people are feeling like Home Depot itself is actually not doing that poorly. They really are at the mercy of a lot of these macro factors. But the company itself is seen as reasonably well run and just kind of riding out this period. And you know, we'll again probably get to somewhat better results as we get into the end of the year and early next year.
Well, it's down almost 6% year to date as the market's up about 10. So really underperforming the S&P so far year to date. John, thanks so much for joining us. Bloomberg's John J. Edwards III there talking to us about Home Depot. Of course, Walmart out on Thursday, which is a real economic bellwether as well. Right now, I want to get to the Qatar Economic Forum. It is in Doha, where Bloomberg's new economy editorial director, Eric Schatzker, is sitting down with Citadel's CEO, Ken Griffin. Let's listen in.
Trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, the United States is a clear leader in AI, along with a number of the European countries. And those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage. And that goes with this rise in geopolitical complexity. So I think that's certainly true, that there are just larger tails today that didn't exist, or we didn't perceive them to exist 7 or 8 or 10 years ago. So that is intrinsic in money management today, and that's something that we think about each and every day at Citadel, is how do we mitigate the tail risks in this world?
How do you mitigate the tail risks?
Well, part of it's sizing. So part of it is how much exposure will you have to a strategy or to a particular sector of the economy or to a particular country. That is the go-to playbook for managing your tails, is just what's the most you're willing to have exposed to a possible adverse event. And then the other strategy is to look for correlated payoffs that will protect you in the event that the tail scenario occurs. So those are two things that you do in your portfolio construction to manage against the tail risk in this environment.
Ken, moments ago you mentioned China and EVs. As it happens today, the Biden administration is levying sweeping new tariffs on Chinese imports, including on electric vehicles. How does that change the picture?
Well, it's sort of a continuation of the incoherent economic policies of the Biden administration. We've seen this giant push towards green energy over the course of the last several years, and at the same time, a set of policies that run completely contrary to the stated goal of trying to head towards a zero carbon world, and placing enormous tariffs on Chinese EVs, which are low cost, high quality, of great value to American consumers, is yet another part of the incoherent Biden economic strategy. The other part of the strategy that I scratch my head about is the U.S. refusing to provide new LNG permits. Right? If you want the world to head towards a lower carbon footprint and move away from coal, access to LNG is a really important part of the equation. And yet the United States is refusing to permit new facilities in the foreseeable future.
And also to sell LNG to countries with which the United States doesn't have a free trade agreement.
That's a part of the equation also.
That said, the United States, amazingly, is a bigger LNG exporter than Qatar.
We're neck and neck. We're neck and neck. And it's very important to understand that if you want a country to base its economy on natural gas, they're going to want two suppliers. It's not a win-lose dynamic between the United States and Qatar. It's a win-win. If you look at any good that is required on an existential basis, you're going to want dual source supply, and the rise of the United States as a major LNG exporter only strengthens the position of this region of the world in providing natural gas to other countries.
Going back to China for a moment, we've talked about China in the past. You have what I would call a constructive view of China, certainly more constructive than many people with whom I've spoken. There is, however, strong hostility to China among both Republicans and Democrats. So how would you explain the way you look?
That is Citadel CEO Ken Griffin talking with Bloomberg's Eric Schatzker. That's right now live at the Qatar Economic Forum. You can continue to follow the conversation from the QEF on the Bloomberg terminal. Just type LIVE GO, live go, to watch more from Ken Griffin and Eric Schatzker. The Open is next. This is Bloomberg.
Maintain a constructive relationship, and we can share the best technologies that our two countries and all the countries around the world develop and build, there's an opportunity for gain. Right now, we have, in some sense, a very muddled relationship, and it's almost as if we're trying to maximize the opportunities for mutual pain. And that's a difficult place to be. It makes the Chinese wary of trusting the United States. It makes the United States wary of trusting China. And there's just a lot lost in that equation.
It would make sense if what the United States wants to do is make an enemy of China, but that's not clear.
Well, I don't want to make this a U.S. only is going after China. It's a two-way street. I mean, the Chinese, for example, supporting Russia's ability to wage war in Ukraine doesn't play well in the United States of America. So there's room for both countries to take definitive acts to just turn the temperature down and, well, if it's a cold war, then it's to turn the temperature up. I'm not sure which way you go. But to improve the relationships and the dynamic between our two countries.
Ken, Qatar is playing an instrumental role in the peace talks, or the effort to create peace, as it were, between the Israelis and the Palestinians, and to resolve the situation in Gaza and with respect to Hamas. You've been outspoken about the pro-Palestinian protests back in the United States. They've roiled university campuses. You've been particularly critical of your alma mater, Harvard. Here's my question to you. When people here in the Gulf region, and across the globe for that matter, see the chaos at Harvard or Columbia or USC or MIT, and police in combat gear moving to clear encampments, how do you think that shapes their view of America?
Not well. Not well. And what is lost is that what's happening on campus is not free speech, it's anarchy. You know, at Columbia, when they storm a building, they vandalize a building, they're destroying property, and then they ask for humanitarian aid, which is the greatest of all ironies. It's just the wrong dynamic that we're seeing take place on American campuses. These are students, most of these students on campuses are trying to learn, they're trying to have an education, and the universities should be really trying to encourage a constructive debate between the students of different backgrounds, whether they're from the Middle East, whether they're of Jewish origin. It's really important that the generation that will be the generation that runs the world in 40 years tries to learn from this horrible moment in history. And we're not fostering that environment on campuses today. And it's a huge, huge disappointment that so much of what we see on campus, you've seen the video footage of the kids interviewed. Why are you here? What are you protesting about? Often they can't even answer basic questions about what's happening in the region and why it's taking place.
Ken, people here, and I suspect those watching us around the world, are eager for your insights into what might happen during and after the U.S. election. How might U.S. foreign policy and defense policy change if Donald Trump were to return to the White House?
So if President Trump returns to the White House, I think you'll see a global perception of a stronger America. Now, the Biden administration's foreign policies, the actual policies, are generally speaking thoughtful. But to be blunt, America does not exude credibility or strength in its actions around the world today. Our positioning does not match the thoughtfulness of our policies. That's a very difficult place to be in a world which has the geopolitical cross currents that we spoke about earlier. And it means that those who are willing to push to see how far you can push America are willing to push harder than we want to see happening. And I think that anybody who knows President Trump knows that is not somebody you just push to see what's going to happen. That's the wrong strategy with President Trump. And so I believe that President Trump will have very good people in foreign policy and in the Department of Defense. But I think he will exude a level of strength that will help to stabilize the world in this very, very trying times.
There has been flagging support for aid to Ukraine in the Republican Party. Would Donald Trump abandon Ukraine?
No, he will not.
You're certain of that?
Well, this goes back to my earlier statement. You could never be certain about President Trump. And that's part of the reason that he is more intimidating to our adversaries. You never know exactly what the response is going to be. But knowing a number of people that he's close to and having actually brought this topic up, I think that President Trump feels he can find an off-ramp towards peace by reaching across to Putin and to the Ukrainian leadership. I believe he knows it's important to American interests that we do not abandon the Ukrainian people at this very difficult moment, and that we keep Russia's territorial ambitions in check. And a strong pushback against Putin will be part of the equation, if need be, to secure the peace in Ukraine.
What do you think he'll do with economic policy?
That's difficult to know. So neither administration gives me comfort in terms of a willingness to reduce federal spending. But I have no doubt that a Trump administration would be far less oriented towards regulatory overreach and far more thoughtful about the role of the U.S. government in the day-to-day U.S. economy. You know, one of the reasons that American voters are so unhappy right now is inflation is out of control. And inflation is out of control because of the expansive government under the Biden administration, the rate of spending, and the degree of intervention in the economy. It's causing energy prices to be higher. It's causing the cost of manufacturing to be higher. It's impacting every part of the economy in a way that the American voters are frustrated about. President Biden doesn't understand you need to break the back of inflation to give people the sense of economic security.
We have talked in the past about America's tendency, shall we say, to spend more money than it generates in tax revenue. And you have warned, Ken, of some catastrophic consequences if deficit spending isn't brought under control. What is the catalyst for an American debt crisis going to be?
So I don't know what that moment will be when there's an auction that goes awry or when the markets become dislocated. Financial markets, generally speaking, work very well until they catastrophically come off the rails. You don't necessarily get a lot of warning that there's about to be a big event. The crash of '87 is a great case study. Mm-hmm. You know, that day I woke up, I was in my dorm room trading then, and the stories of the day were about a small skirmish in the Middle East of frankly no consequence, and the health of First Lady Nancy Reagan. And yet we ended that day with the stock market down 20-some% and a number of American financial institutions literally on life support or near death. Happened in one day. One day. There was no big story that morning that would make you think that that day might have been the end of the U.S. capital markets as we knew them. There was no warning. And so I worry that the debt crisis may have a similar construct, that there'll simply be a day where a major auction fails, and then you see a panic start to brew in the Treasury market. And the question will be how fast will the Fed intervene? What panic will that induce? Because government intervention under duress often just creates more panic. And then do we see a flood of treasuries coming back into the market from holders around the world?
It's a frightening prospect.
It is.
Back to politics for a moment. You've been a prominent donor, I would say, to Republican candidates. I'd like to know, how are you going to spend your money? How are you already spending your money ahead of the election in November?
So I have been a significant supporter of Republicans that stand for personal freedom, national security, and economic soundness of the United States. That has been a big focus of mine in this primary election, or this primary cycle. I want to see people in the House and in the Senate that represent the best of American values and backgrounds that prepare one to serve in public service. In the last election cycle, I supported a number of people who were veterans and who are now serving our country in the House, and they do it with the pride that our country deserves, and they do it with the integrity that our country needs. So I've been very focused on finding candidates who I think represent the best of American values to be part of the future of the Republican Party.
People probably want to know, have you donated to Donald Trump's campaign, either directly or indirectly, to a PAC or a super PAC?
I have not.
Will you?
I'm going to wait to see who he picks as his VP candidate.
Is there anyone whom you'd like to see him pick as his VP candidate?
I don't, this is again like poking the bear. Not sure which way my recommendation goes in terms of helping that person's prospects.
I think that's a wise position to take. Before we finish, Ken, this region is blessed with resource wealth and, as a result, sovereign wealth. So much so that pretty much every major asset manager in the West sees the Gulf as something of a honeypot and is trying to raise money here. As someone who isn't raising money here, how would you advise the sovereign wealth funds in the Gulf region to maximize their negotiating leverage?
So either I'm going to be excommunicated from this circle of my fellow money managers, or never invited to come back to the Middle East again. Is that the position you're putting me in? So look, here's what I think is important to think about. I think alignment between the interests of the money manager and the sovereign wealth fund are very important. And I think it's more important to have your money entrusted with a firm that is going to act continuously in your best interest as an investor than it is to try to pick somebody who simply has the lowest fees or some other superficial demarcation of being open and transparent. I mean, let's be clear. Your money managers who have really important intellectual property aren't going to be unduly transparent. They're trying to protect their very intellectual property that they'll share the benefits with the client. Simply put, Coca-Cola doesn't publish its recipe on the web. So I think it's very important when you find a money manager, you're really asking, what's their competitive advantage? What's their culture? How aligned are they with me? And in the good moments and the bad moments, are they going to put themselves in the shoes of their clients and make the right decision by their clients? You know, at Citadel, I take great pride that almost over 20% of the capital in our hedge funds is the capital of the partners and the team members at Citadel. We wake up every single day as co-investors with our capital providers. And I think that symbolizes what I would think about looking for if I were a member of the sovereign wealth community here in the Middle East.
One last thing. Among the many distinctive qualities that Citadel is...
Just by the way, when you're going to go pick a brain surgeon, do you find the doctor with the lowest fee?
That's not what I would do, no.
Right? So you want to find somebody who actually has pricing power because other people perceive them to be good.
It says something, yes.
There's something to be said for that.
I was just going to say, because I think it would certainly interest people in this room and elsewhere in this part of the world, one of the things that Citadel is known for is how seriously you and your colleagues take the search for extraordinary talent. A number of investment firms have opened offices in this part of the world, whether it's in Doha, whether it's in Abu Dhabi, Dubai, for example, or Riyadh. Have you thought about expanding here?
Well, we actually just recently did an analysis of our competitors' footprints in a number of these cities as we try to think about what is our strategy here in the Middle East. And you landed on the right issue. It's about talent. And when we think about our Middle East strategy, we're going to think about where are we going to draw the greatest amount of talent, both from the domestic country and from the international community. Too often, countries try to attract talent by having very attractive tax attributes. That tends to draw in a handful of senior PMs, but doesn't draw in the analysts and the associates who do the day-to-day work that's required to be successful in the markets. You know, one of the reasons that I think Citadel has been so successful is the intense collaboration that we have within our four walls. A PM working side by side with an analyst, with an associate, working through a problem. Having a PM located in a low-tax jurisdiction on Zoom intermittently with a team back in London, that's not a winning formula. So when we think about where we're going to be in the Middle East in terms of our footprint for human capital, it's going to be about a holistic solution where we've got people who are in the region integrated tightly with PMs who are here. The whole team is here and successful as a team.
It explains a lot. Ken, thank you very much. Ladies and gentlemen, please join me in thanking Ken Griffin.
Thank you, Eric.
That was the Citadel CEO, Ken Griffin, speaking with Bloomberg's Eric Schatzker at the Qatar Economic Forum. Very interesting panel in terms of his views on, I guess, politics and economics, as well as the war in Ukraine. Right now, though, let's get to some breaking news back here in the U.S. on markets in tech. Joining us from the West Coast is Bloomberg Tech's Ed Ludlow. And Ed, we are hearing about a change at the top of Amazon Web Services, AWS, a hugely important unit of that company.
Yeah, Adam Zalipsky is going to step down as CEO of AWS, Amazon Web Services, the cloud unit, effective June 3rd. Matt Garman, who's been at AWS since 2005, will take over in the CEO role. In a letter to staff and shareholders, Andy Jassy, who's the overall CEO of Amazon, said that Adam Zalipsky has decided to take a next step in his career and move away. AWS is just so critically important, right? And Adam Zalipsky leaves AWS in pretty rude health. $100 billion revenue run rate. He's really made AWS the mainstay of Amazon's cash flow. It's basically the majority of operating income, right, away from Amazon's other e-commerce, healthcare and logistics offerings. And so it's an interesting change. When the news broke just before the market open and into the market open, shares did decline by around a percentage point. We're down 0.9%. This is Adam Zalipsky, according to the communications Amazon's put out, doing this of his own volition. He's kind of an interesting guy. He himself was at AWS on the early days, 2005 as a VP. He later went to lead Tableau as CEO, then returned to AWS to lead as CEO after Andy Jassy took the reins at Amazon from Jeff Bezos. So he had a pretty good 3-year stint there. Matt Garman's interesting. He started as a very junior sort of MBA hire in 2005, held a number of roles, long serving. We need to kind of learn a bit more about him, or at least the market does, based on the negative reaction of the shares down modestly 0.8%. But again, Zalipsky leads AWS in rude health. And you don't see much divergence of the strategy, which is basically be the market leader in cloud, provide the compute for developing large language models and AI. And as we learned on the call just a couple of weeks ago, Amazon is now making revenue out of generative AI with a revenue run rate in the billions of dollars itself. And that's where Adam Zalipsky leaves AWS.
All right, very interesting stuff indeed. Ed Ludlow there from Bloomberg Tech can catch his show in just a couple of hours, and I'm sure they will zero in on this Amazon issue. Coming up, we're going to speak with BlackRock's Kate Moore to break down this morning's PPI data, inflation data, CPI, of course, coming out tomorrow. How does the market see this? How does the Fed react? This is Bloomberg. BlackRock's Kate Moore joins us to weigh in on the equity market. She has written, even after a solid first quarter reporting season, equity sentiment remains tepid as concerns around sticky inflation, cracks in the consumer, and policy uncertainty weigh on risk appetite. She joins us now to expand on that. Kate, I gotta say, I'm just back from 6 months of paternity leave. The equity market looks pretty strong to me, especially considering the slowdown that we expected when I left. Does 5,200 not look tasty?
Well, Matt, I'm talking about sentiment today relative to where it was at the end of the first quarter. You know, we've come off the boil a little bit in terms of enthusiasm. But yes, of course, the equity market looks much better than it did 6 months ago. I will tell you, I was pretty bullish 6 months ago, and it felt a little uncomfortable at times. But most of the data we were seeing was suggesting not only no recession, but actually continued strength on the corporate side and a real focus on delivering earnings. So I think we've been in a good place. But more recently, as I mentioned in that note, you know, we've seen these three things weigh really heavily on overall investor sentiment. That first being, you know, sticky inflation. Of course, today's PPI, I don't think really is going to go a long way to help sentiment there. The second is like what consumer companies and even kind of broader companies have been saying as they've been reporting first quarter earnings, sometimes noting significant cracks in the low end consumer. And then the third, of course, is, you know, given the fact that this is an election year and given the fact that it's a very complicated decision for the Fed, what kind of policy adjustment can we expect in 2024? So I think people are using these three things as an excuse to maybe sit on their hands a bit. Not necessarily cut risk, but sit on their hands.
There's a lot of moving parts, obviously. As you note, the first quarter earnings season was pretty good. Indeed, analysts have been moving their earnings estimate up for the second quarter and for the full year. We've had three back-to-back quarters of earnings expansion after 3 quarters of contraction before that. It seems like companies have been doing well despite the Fed. But the consumer, I guess, is the bottom line, the biggest issue for you. How do you expect the lower end or even the middle consumer to do throughout 2024?
Yeah, let me just go to that point on earnings really quickly, which is you're right. Earnings came in the first quarter much better than expected. When we saw the price reaction of stocks as the companies reported their earnings, we sometimes saw a very tepid response. I'm kind of into that word at the moment, tepid response in terms of price action, because a lot of times these companies were not meaningfully raising guidance. They were reaffirming guidance they'd already given, and the market wanted something even more. So good results, really solid prospects, but it didn't raise guidance, and that didn't inspire a lot of new money to work. I think that's an interesting and kind of healthy environment and setup into the second quarter as we deal with some of these economic data, consumer, and Fed policy concerns. Your question, though, is kind of about, what do we do around inflation and the low-end consumer? And this is a huge conundrum, and one of the reasons why I jokingly, but not so jokingly say, I think peeing on the Fed and being a Fed decision maker at this time is incredibly difficult. Because in aggregate, I know you guys were talking about this earlier, the consumer data looks strong. Right? We end up having a consumer whose debt burden is not too onerous, that when you look at even mortgage debt payments as a percentage of disposable personal income, it's kind of in line with a very long-term average. But of course, these averages, we know, don't tell the story. And this is why people have been so focused on the anecdotes from companies talking about kind of the lower 2 quintiles. We'll call it the bottom 40% of earners. And they've said, these consumers are visiting stores less often. They've changed some of their purchasing habits. Maybe the basket of goods that they're purchasing is smaller. So all of those things are raising some flags. I think what we do here is, in terms of our consumer exposure, is stay up in quality and stay up in kind of consumer preference towards higher income households. But we watch very closely to see if policy has to adjust for these lower end households.
I see that, obviously the pressure on the lower end consumer, high rates aren't helping, the debt load is growing, and even, hard to see because of the increase in buy now, pay later. But how do you juxtapose that with the liquidity and froth that's clearly in this market? I mean, GameStop was trading at 17 on Friday night. Then Keith Gill releases a picture of someone playing a video game, and all of a sudden it's trading at $50. Bitcoin is trading at $62,000, not long after Sam Bankman-Fried goes to jail for pretty much the rest of his life. So how do you square that circle?
Yeah, look, here's what I will say. I think after the first GameStop mania, people thought, okay, the retail investor, that kind of speculative Wall Street bets cohort is not necessarily going to continue to participate in this way going forward. And I think what we've seen over the last trading day or so is that we can get the retail investor and sort of speculative traders to really come back into the market in force. So as we think about the dynamics in the market, we weigh a couple different segments. Positioning and sentiment matter a lot for our entry and exit points. Of course, we think about institutional investors, kind of long duration investors, and then faster money investors. We think about wealth management, high net worth individuals who tend to take a kind of a longer term horizon as well. And then we also have to consider what can happen on the retail side and how quickly that can move. So I don't know how much this can persist, but I will say as we're assessing the state of the market and looking at all of these different components, we do have to factor in that the retail investor can come in and sometimes and really move the market in a big way.
Kate, thanks very much. Great to catch up with you. Kate Moore there from BlackRock. Let's get more now on Amazon. For that, we go back to Abigail Doolittle. Abigail?
Well, we do have some new information, Matt, and right now the stock is down about 1%. Matt Garman has been named the new AWS CEO to replace Adam Selipsky. And based on Matt Garman's LinkedIn page, he has been with Amazon since August of 2006. Most recently, prior to being named the AWS CEO, he was the senior vice president for AWS sales, marketing, and global services. This, of course, all comes on CEO Andy Jassy making these executive changes. So Matt Garman being named AWS CEO to replace Adam Selipsky.
All right, Abigail, thanks very much. Covering all the stocks that are moving for you today. This was the countdown to the open. I'm Matt Miller. This is Bloomberg.